And so quite often we have to ask ourselves, what is the purpose of our investment? What are we trying to achieve from our investments? Is growth a consideration of what next for our investments? And just because something is inexpensive doesn't mean it's right. Quite often the consensus of real estate is built into the price. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, we're going to dig into the old urban and regional conversation. It does rear up every now and then. There's always a good debate. Where should we be investing? And today I wanted to crack that code, go into some detail of how to move the chess pieces across the chessboard. And of course, the chessboard is the Australian property marketplace. And of course, if you want to understand more about the Australian property marketplace, you can always get my little book, The Australian Property Game. It's actually got lots of information around risk-adjusted returns, really understanding the idea of regional investment versus urban investment fundamentals. But hey, let's do it. Welcome back, regulars. Play the program in double speed, get your life back. And of course, all the episodes I've done are lessons on real estate, so feel free to go back in time. But let's do it. There's always the battlegrounds. There's always conversation. Should you build a positive cash flow portfolio? Should you chase capital growth and take money out of your back pocket and invest in the future? Because quite often, capital growth comes at a cost. It's not free. Nothing's free in real estate. And of course, that freedom of using your money to create capital growth quite often can cause people a little bit of angst and, of course, push people sometimes into directions which have been proven to be a little bit unsafe when it comes to investment. That is going too regional, too off the beaten track. Now, I guess when we think about real estate, what is normal and what is abnormal? It's a decent enough conversation. When we look at the median price of housing across our major urban areas, the new normal is $1 million. $1 million. The median in most capital cities is basically $1 million. So if you're buying below the midpoint or the median of what most people buy, you are buying below what is considered normal. Effectively, you are entering the abnormal marketplace. And of course, in regional marketplaces, the regional normal price point is circa $700,000. If you're buying below the normal, the median, you are potentially buying something which today in Australian real estate is considered abnormal. Now, you may have thought you found some sort of hidden gem where you stumble across a property worth $200,000 renting for $350 a week, but I can assure you that is not normal. That is abnormal, and abnormal not in a good way, abnormal in a dysfunctional way. And of course, some regional real estate is just really too dysfunctional. I actually have the personal lashes on the back from doing positive cash flow strategies, going off to mining towns, regional communities that are too remote, and of course ended up in a place where I had very little growth on real estate, but I was having the rent cover the cost to run the real estate. The portfolio just span its wheels because it never grew. Growth is really one of the biggest fundamentals as to why you would buy real estate. It's really the idea of taking a property today worth 700 and turning it into 1.4, that 1.4 going to 2.8, that 2.8 going into 3 million plus. So we want real estate which is going to perform, not just on the day of purchase, but through cycles, through this cycle, through the next cycle, and really through the cycle beyond that. And so quite often we have to ask ourselves, what is the purpose of our investment? What are we trying to achieve from our investments? Is growth a consideration of what next for our investments? And just because something is inexpensive doesn't mean it's right. Quite often the consensus of real estate is built into the price. And of course, there are two powerful questions you need to ask yourself when it comes to property investment for growth. What is the geographical path of growth? What is the geographical path of growth? And do the demographics match the geographical path of growth? And so I always break down the concept of building a portfolio. You're going to have to move your money to a location. In Australia, we have global cities, Melbourne and Sydney. They're pretty much the biggest places in Australia. And of course, quite often, there's still opportunity even in our global cities, particularly Melbourne at the moment. New world cities, you've got Brisbane and Perth. They're great places to invest. They'll do well over time. Brisbane's got the Olympic Games. It's going to be highlighted to the entire world. Then we've got our primate cities, sort of places like Hobart and Adelaide. They're, well serviced. There's huge populations. They're basically capitals of their states. And so they do very, very well from an investment perspective. Then you've got those feeder cities, which I just love investing in, places like the Gold Coast, Sunshine Coast, Toowoomba, Newcastle, the Gong, Geelong, Ballarat. These feed into our major cities. Geelong feeds into Melbourne, Newcastle feeds into Sydney, and to some extent, Canberra, though a huge capital city, really does also offer really a almost feeder environment into Sydney as well. So feeder cities are those capitals of their states or territories, those new world cities, global cities, are great places to invest. And of course, from a regional perspective, if a regional community sits within commutable distance to a major urban area, it's going to do really, really well, whether it's serviced by road, rail, train. It's going to do well. And so there are regional cities which, are 2 hours from a major urban area, places like Bendigo. It will do well. But where real estate starts to struggle is when you start to go to really quite isolated communities. And really they're isolated by virtue of their geography. And of course, they may be serviced by a small airline like a Rex Airlines or something, or Qantas Link, but ultimately they are pretty regional places. And of course, these regional places can be really small within their actual greater region and can be effectively dying towns, just towns which are basically truck stops or train stops, or really the only reason they exist is, an aging population which can't move out of the area. And of course, perhaps the only reason they service the world at the moment is a fuel stop or a train stop. So you got to be very, very mindful of these sort of broken down towns, because Australia's had a few dying towns over the years, few ghost towns. I've been known to holiday in a ghost town. I go to Hill End, yes, in New South Wales. It's an old gold mining town. It's a beautiful, beautiful town, but no one really lives in it. And it's full of abandoned buildings, but you can still pan for gold there. So don't underestimate that over human history, towns do die. And so will towns die into the future? It's really an interesting conversation because when we look around the globe, there is evidence that towns are dying. If you go to Europe, you can go to many, many small villages in Italy, in Croatia, in just about every country in Europe, and you can buy a property for as little as $1 because no one wants to live in those areas. And really, those areas are just now places where old people live, but young people don't because of the inability for that area to service lifestyle, to create good education for families, to offer the right employment opportunities, and of course, that means that those towns just simply die. Now, if you ask someone 30 years ago, would a beautiful little village in, Tuscany just die? People would say, oh, no, it's not going to happen. But guess what? It happened. And of course, in Japan, there is a word which basically is IKEA, which means empty house. Empty house. And Japan has millions of empty homes because old people basically pass away and there's just not enough sort of young people coming through the system to warrant keeping the house. And so not only are we going through a global depopulation in some contexts, that we're also urbanizing. We're urbanizing. And so as a human race, we're actually drifting into cities at a rapid rate of knots. Now, of course, over the last 5 years, we've been through a pandemic, which has created a lot of a digital transformation, and that has benefited a lot of regional communities. And a lot of people now can find lifestyle opportunities in regional towns, affordable properties in regional towns, and work remotely. But there is, again, in my opinion, a regional town which works and a regional town which would be just too remote to work as a property investment. And so you've got sort of towns out in sort of Western New South Wales today, which are 14 hours from Newcastle or 14 hours from Sydney. And, they're fairly broken. You've got Broken Hill, you've got Wee Waa. And I've invested in some of these broken places in the past. I invested in a place called Moree. Now, there's nothing good about Moree other than its artesian spring water. If you have arthritis, then you should go to Moree and you can get in the artesian spring water and feel your youth come back to you. But other than bathing, there's not too much going on in Moree. There is cotton, which is an industry, but it's really a one industry kind of marketplace, the old Moree. And of course, when I look at the property I bought in Moree, and I subsequently sold it, way too long I held it for, never went up in value. And I look at it today, and it still hasn't gone up in value. It's still the same price, and it's still the same rent. I bought it for $140,000 and it was renting for like $280 a week. Today it's worth $140,000 and it's renting for $280 a week. It on paper looks like a great investment, but when you adjust for the return, when you adjust for the lack of capital growth, it actually has been a terrible investment. And it will continue to be a terrible investment. And that property that I'm referring to I've been tracking that property now for near on 20 years. 20 years. So where do you move your money to? We want to move our money to the geographical pathway of growth. That's really how real estate works. Where is the geographical path to growth? And does the geographical path to growth match up to what is going on with demographics? And of course, in demographical terms, here in Australia, there's a couple of things afoot. There's the millennials that are having children and looking for 3 and 4 bedroom properties. The geographical pathway to growth is housing for those families. Where do those families want to live? Where there's lifestyle, good education for their kids, and good job opportunities. That's really what the geographical pathway for growth is for those people. What does that look like? Well, that looks like affordable housing in our urban areas and our regional communities, which are quite often feeder regional communities to urban areas. The other geographical pathway to growth with a demographics twist to it is the silver tsunami. We've got a large cohort of baby boomers which are wealthy, that have made a lot of money over the many years they've been alive, and they're investing in trophy assets. They tend to want some of those pretty beautiful beachfront properties in our coastline, on our coastline. So we know where growth is going, and we know what the volatility is of marketplaces which are aging. There is volatility at a global level. Will the community just grow too old that it can't replace itself and this town starts to pass away? And I know it sounds crazy because we don't live in the times of the gold rush, but this is occurring. It is occurring. It's occurring in England. It's occurring in Italy. It's occurring in Western countries. And so we have to face the reality it could actually occur here. So if we're going to analyze a regional community or any piece of real estate in any marketplace, we want to actually start with its economic diversity. And you could create a little scoring metric if you wanted to, but economic diversity is important. Now, if you look at the economic diversity of Sydney or Melbourne or Brisbane, there is a plethora of economic diversity, whether it's in sciences, whether it's in healthcare, whether it's in agriculture, whether it's in mining. Like, there are offices and industries connected all over the shop in urban areas, whether it's in the financial sector, whether it's in the legal sector. Urban areas have economic diversity, more economic diversity than anywhere else. So the resilient score of economic diversity in urban areas outscores one industry towns. Moree, the main industry is cotton production, basically cotton. So one industry economic diversity versus a resilient sector of economic diversity, multiple industries, you can't compare the two when it comes to the scoring mechanism of risk. It's just they don't add up. And of course, somewhere in the middle, you have maybe a marketplace with several cyclical industries. And, you've just got to weigh up whether those cyclical industries will affect the real estate. A cyclical industry could be mining. It goes in cycles. Iron ore prices change all the time. Coal prices change all the time. Coal was in vogue, then it fell out of vogue. It became very cyclical as to the economic diversity of many mining marketplaces. So when you're looking at real estate, give it an economic diversity score. And maybe that'll help you make a good decision on what next for your money. Obviously, the population trend. Is the population shrinking? Is it flat? Is it erratic? Or is it consistently going up? That's all we need to know. These are the only questions we need to ask ourselves. And of course, in urban areas and feeder cities, the answer is consistently going up, consistently going up. Is the population shrinking, or is the population erratic? And so my experience, for example, in Moree was the population was very erratic. It would come for harvest and leave after harvest. Once the cotton was picked, the cotton pickers would leave. And of course, when you've got an entry-level property which is abnormally priced compared to what is normal, a normal price, even in Moree for a good house, is $500,000-$600,000. If you're buying at $200,000, then you're buying an abnormal property, and you're going to attract the erratic behavior of even the population. And for me, I would attract cotton pickers, and that would take that $280 a week rent and probably what was not, advertised was, the vacancies, how often it was vacant. Yes, it could produce $280 a week rent, which was more a price to chase off really the lower socioeconomic from even applying, but it didn't factor in the vacancy. So we want economic diversity, and we want to give ourselves a resilience score around economic diversity. If we're one industry, we're not scoring anything. If we're a cyclical industry, we don't get anything. If we're resilient and we have multiple resilient industries, we're going to give it a tick. If we've got consistent upward trends on the population growing, we're going to give it a tick. If it's erratic or shrinking, we're gonna have to put a cross through that. No deal. And so this is important, because if you want to become wealthy out of real estate, you've got to buy some real estate, but you've also got to create capital growth from the asset. And again, some of this stuff looks great on paper. You put it into a spreadsheet, it looks amazing, but a spreadsheet in the real world, quite often two different things. Of course, you want to understand infrastructure. Infrastructure is an important element because it is a signal of reinvestment. If you are reinvesting in your community is growing. New roads, new hospitals, new logistics, new businesses, new commercial precincts, new residential precincts, new retail precincts, new airports, new subways. Like, growth tends to follow infrastructure. And if there's absolutely no investment, then you have to put a cross through the investment opportunity of buying there. It's a no deal. If there's minor works going on, like the local council's just doing a bit of an upgrade on some stormwater, on Betty Street, it's not exactly infrastructure. When you've got major projects underway or planned, then you've got growth. And so again, like, even your great feeder cities have major projects underway. You should see the plans for places like Ballarat, Geelong, Newcastle, the Sunshine Coast, like incredible infrastructure planned for those what are assessed as regional communities. Just amazing. But when you start to get too far afield, there is no infrastructure planned, so you can't give it a tick. You can't move forward with the investment. And of course, when real estate is designed to be an investment is designed around supply versus demand. And quite often the idea of no new builds or no new real estate being put in an area is kind of misunderstood as, well, there's no new supply. But actually, the only reason there is no new supply is there's no actual new demand. And so in bigger places, your global cities, your new world cities, your primate cities, your feeder cities, there is new supply, but there is new demand. And so you get this cost push effect on real estate, where the price of new real estate is often pegged to the price to create new real estate. And so you get this inflationary effect on growth because there is always extra demand. And so if you look at a marketplace and there is no new real estate being created and it's a regional community, it's just a stagnant marketplace. And so you can actually assess it with no growth signs of more people required for the community. And again, like rising demand and new housing is a signal of growth. So we've got to, again, create an assessment when we look at those marketplaces. Is there actually new housing being created for the future of a growing population? Or is it actually just everyone's buying these old properties over and over again? Some bogans having some babies and, getting on Centrelink and really that's the model. That's it. That's what's going on. It's basically the established housing that is now 50 years old going to Charmaine's new baby that is going to be on Centrelink. And is that the business model of capital growth from real estate? So we need to be very, very mindful that these places can have very poor socioeconomics, very poor livability. And you have to ask yourself, would someone want to live there? Would someone actually want to live there? Would you want to live there? Would you want to live there? If you looked at a very regional place and said, the maths looks fantastic on this investment because I can buy a property for $200,000 and it's going to rent for $380 a week, would you yourself want to move there? Have you even been there to see what it looks like, but would you yourself want to move there? Now, when I go to feeder cities like Newcastle, I go, would I want to live there? Yeah, I'd live in Newcastle for sure. It's got beautiful beaches, great bars, old historic buildings. It's got everything I like in life. When I go to Ballarat, I go, yep, I could live here. It's got a beautiful old main street. It's got great retail, cute little coffee shops. I could do it. If push came to shove, I'd be happy to live in Ballarat. If I went to Toowoomba, happy to live there. If I went to Sunshine Coast, I'd be so happy to live there. If I went to Wollongong, happy to live there. Gold Coast, happy to live there. Regional Northern New South Wales, happy to live there. Would you actually be happy to live in Weewar or Moree? Or would you be happy to live in Broken Hill? Or would you be happy to live in these places? If you wouldn't be happy to live there, why do you think someone else would be happy to live there? And so amenity and livability is just a critical piece to this puzzle. Well-rounded livability is the tick. Well-rounded livability. Great schools, shops, lifestyle, things to do, nighttime economy. This is what drives people wanting to live somewhere. And minimal services, remoteness does not work. And again, people do live there, and that's just that's the reality of it. People live all across this country, but do they really want to live there? For a lot of people, the answer is no. They're just socioeconomically stuck there, and they've never been able to get out. And of course, really, you've got to also look at some red flags when it comes to risk, natural disasters, cyclones, cyclical challenges with flooding, drought. Like, all of this stuff is quite real. And again, if you do an assessment, you go, well, like, what is the likelihood of this place becoming the next Lismore? Well, the likelihood is a lot higher if the climate actually reacts by 1 degree and goes up. The water source of this town could be wiped out. You are essentially putting your money in a very risky marketplace. Disaster risk volatility is real. And so what we do know is your Newcastles, your Geelongs, your Ballarats, your Melbournes, your Sydneys, your Perths, they're going to be looked after because that's where the taxpayers live. That's where taxpayers live. Millions and millions and millions of taxpayers. Even if the sea level rises, Sydney Harbour is going to be looked after because that's where the taxpayers live. So even though there's people that live in small communities of 5, 10, 20,000 people, the problem politically, from a volatility perspective, when things go wrong, is they kind of get shoved on their own when it comes to, what next for them. That's the reality of it. Now, again, positive cash flow is a great thing. Obviously, getting a high rental return is great because you don't take money out of your back pocket. But make sure you do your regional investment research, due diligence. Go deeper than just the numbers. Numbers are only part of the story. And start to filter things. Volatility of natural disasters. Would you live there? Amenity and livability. Demand and supply is really, it's just basically, the existing housing stock, which never gets updated. And it's just a spiral of challenges around that. Infrastructure pipeline, population trends, and economic diversity. All of that is an important concept because remember my 4-quadrant property investment selection system. You've got capital preservation. We want to preserve our money. We want to put our money into the deal. We want to get it back out of the deal. We want to double our money. It's going to come from hard-earned work money, or it's going to come from another investment. We want to make sure that money goes to work for us. We want to preserve our capital. We want growth, yield, and we want good tax deductions from real estate. So make sure you end up in a place where you buy the right real estate. And some regional marketplaces are doing well. And I've mentioned this before on previous podcasts about regional marketplaces. Some of the best performing and most expensive real estate is now regional. Byron Bay, Kiama, the Surf Coast, just near Geelong, Noosa, Bowral, Gold Coast, Kingscliff, Sunshine Coast, Wollongong. Very, very, successful real estate marketplaces. And so just remember that if there's some lifestyle benefits to regional and it's close enough to urban, it's going to do pretty well from an investment perspective. So I'm all for it. I'm just opposed to those really off the beaten track real estate hotspots, which are driven off basically positive cash flow concepts. Now, again, I'm probably the converted because my company is called Positive Real Estate. When we started the company, we went to these towns. I've been there. I've lived this. And so I share this not as a sideline commentator. I share this as someone who's got the lashes on the back from buying in a lot of these places. Coolgardie, Kalgoorlie, Port Hedland, Moree. I've bought there. I've been an investor in these places, and I can tell you the system of getting too far off the urban track is fraught with danger. On a spreadsheet, it looks amazing. Get a 10% discount. The vendor will drop the price 10%. The rental yield is 10%. You can't go wrong. Well, you just spin your wheels for a very, very long time. Property doesn't necessarily go backwards, but it certainly doesn't go forwards. So if you want to retire from real estate, make sure you keep moving forward. All right, folks, that's it from me. Talk soon. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.